Hello everyone, welcome to today's US Open live webinar. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. We're 10 minutes before Wall Street opens as always, and Thursday, August 10th. US CPI just came out less than an hour ago without any big surprises and slightly better than expected with a mixed impact on markets so far. Yesterday, we had final CPI, which showed that both the consumer and the producer side are now in deflation territory. And we also have a very busy earnings week. But Disney, I think, is the one that dominated the earnings calendars. We're going to talk about that and the stock outlook. First, however, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read over through the risk warnings and the disclaimers. And bear in mind that anything discussed here does not constitute investment advice. Let's give it a few more seconds and then we will start. Okay, let's get the ball rolling. We have another packed session today, quite a few things to talk about. But first, we're going to start with Euro USD and the US CPI report we mentioned. Then we're going to move to China inflation and the impact on copper prices. We'll move forward with Disney stock outlook after yesterday's results and proceed to National 100 as we will, and then we will round things off with what's ahead as always. Now, in regards to Disney, of course, you can find at the end of this YouTube video, you can find a link that will take you to a video with a quick take on what those results contained. We're going to mostly focus on the technical outlook in this session. So US inflation has been coming down, but today's CPI's report showed an uptick to 3.2% in the headline. The sticker core inched down to 4.7% year over year. Both were marginally better than expected. Knee-jerk reaction was higher on Euro USD, but doesn't look like it lasts for now. We're already seeing a pullback from that, as you can see on this chart. Now, this print, similar as what we saw with the NFPs last week, probably maintains all options on the table and doesn't seem to change market expectation for a pause on September. However, there are more data due until this meeting, and as we've already discussed, central banks are non-committal and data dependent, so every piece of economic release matters. Now, Euro USD is up since yesterday and reclaims the 200-period EMA. This brings the July highs back in the spotlight, but I think they still look far. I'm cautious about Euro's ability to tackle it at this stage. And despite this improved sentiment for the common currency, there is still risk for further decline back towards the 200 days EMA, which is located around 1.08, but still a strong catalyst would be required for a breach and further weakness below that. Again, the incoming data are critical here because of this uncertainty around what the central banks will do, a theme that we have covered extensively in this series. Now let's talk about copper prices in relation to China's CPI data. And of course, the streak of disappointing releases continued and points to a frail recovery in one of the world's biggest consumer of copper, which is also heavily used in the important property sector. Consumer prices fell below zero for the first time in more than 2 years, and producer prices stayed in deflation territory for 10th straight month. However, copper yesterday reacted positively, likely because Chinese authorities have already taken measures to support the real estate market and have pledged more help for the sector and for the broader economy as a whole. And the poor data seem to reignite some hopes for more action to come. Now, copper tries to move past the 200-period EMA, but the daily Ichimoku cloud could still contain a recovery towards a new month highs at 4.02. Below that, however, below the 200-period EMA, the black line immediate bias is to the downside, and risk for a breach of the ascending trend line from the 2022 lows remains, which is at around 3.65. Although strong catalyst, it would be needed for those of the current year further down below. There is risk for copper because the real estate market is still in a precarious position in China, and measures to improve the economy so far have been, let's say, vague. Okay, let's switch gears and we're still 2 minutes out of before the US session. Let's go to Disney. Let's bring Disney on our screens. The market hasn't opened yet. So the entertainment giant is going through a rough patch, and Wednesday's quarterly results after markets closed highlighted some of those issues, but also offered reason for optimism. Again, at the end of this video, you can find a link to a quick take of those results and also in-depth analysis on the FXCM market analysis websites of your respective regions. Now we'll focus mostly on the technical outlook. The stock is flat on the year after the 2022 losses. And you can see the black line represents where the last year closed. So over the last few weeks, we've been hovering around this in essentially break-even territory. And that is because markets contemplate the hardships that Disney is facing and the efforts, of course, to turn things around and promising signs. From a technical perspective, the stock is exposed to the pandemic lows at around $79, and further decline can definitely not be ruled out. However, markets to me appear overly harsh, and I find it difficult to see what would justify moves below the pandemic lows. Yes, there are some issues, but still, in terms of streaming, it's neck and neck with Netflix. Financials are improving of the segment, and expected profitability by fall of 2024. And its content it's hard to rival. It has huge potential, which can be unleashed with Mr. Iger's restructuring plan and drive the stock forward. Markets reacted positively, actually, despite the results were overall mixed, but markets reacted positively, and the stock is up in pre-market, which is a good sign. But the truth is that the immediate upside is quite unfriendly. You can see now the market opens, and you can see how the stock gains and tries to get into the daily Ichimoku cloud. But right after that, we also have the 200 days EMA, the black line on a daily chart, and it will need to close above this black line in order to shift bias on the upside and be able to look further ahead. But the truth is that over the past year or so, it had difficulty moving and staying above this level. So overall, we're still a bit cautious, but we think that there is great potential for Disney that could help drive the stock forward, but markets would need to view it this way. And so far they have been a bit, let's say, harsh. And having said that, let's go to NASDAQ 100, where the truth is that not much has changed on the technology sector. It reacted positively to today's CPI because, again, it doesn't change. It doesn't seem to change market pricing for a pause in the terminal rate around the Fed, but it closed below the 200 period EMA yesterday, the black line again, and that does create risk for a breach of the upper side of the daily Ichimoku cloud, a little below the 15,000 mark. But deeper corrections that we tested for the 14K level and a little above 14K, 14,100 still seems to be that it has a high degree of difficulty. Now, the 16K mark now seems a little bit further given this recent weakness, but it's still my main expectations that the index will hit that level. Now that's it in terms of technicals. As always, let's round things off with what's ahead. We expect UK preliminary Q2 GDP on Friday. Q1 final was plus 0.1% Q on Q, and the BOE does not see a recession anymore. We also have the employment data from the UK again on Tuesday. The labour market is strong and we have historically high wages. Governor Bailey has repeatedly said that the pay levels are not consistent with the 2% inflation target, and actually reiterated that after this month rate hike. So the bank will definitely need to see some more cooling there, some more substantial cooling if it is to stop hiking, which doesn't look easy at where we are now. But again, there's a month until the next meeting. We also get Canada inflation next week. The BOC has delivered 2 straight hikes in the summer after its previous pause due to an uptick in inflation, has kept the door open to more tightening, fear that progress towards the 2% target could stall. As such, the updated figures will be significant. And on Wednesday, we have the Reserve Bank of New Zealand. It had stayed on the sidelines last month in a watershed moment after 12 straight hikes worth 525 basis points. Its projections suggest that the terminal rate has been reached. The economy is in a technical recession and the inflation is coming down. So this definitely bode well for this pause scenario and the terminal rate. But on the other hand, inflation is still far from the 1 to 3% target, while the labor market is tight and wages are high. So that gives potential for further tightening, I think, open. That's pretty much it. And let me reiterate, central bank right now is central banking right now from all major central banks is very uncertain. And I have written extensively on the topic how this non-committal stance sets us up for an uncertain autumn. Again, that's something you can find on the FXCM website analysis of your respective regions. That's pretty much it from me for today. Bear in mind that the US Open won't be hosted next week, so we will return on Tuesday, August the 22nd. Thank you for joining me.